All right, welcome back to the deep dive. Today we are looking at the big one, the union budget for FY27.
Yeah, and it's a fascinating one.
It really is. If you've been following the headlines, it feels like the government is walking this incredibly fine line.
A tightrope, for sure.
Yeah,
Balancing massive growth ambitions with keeping the checkbook balanced.
exactly. And the mission here seems pretty clear, doesn't it? They're aiming for that Viksit or developed India status.
They are, but the core theme isn't just growth at any cost. The report calls it sustaining investment-led growth.
So it's about being smart with the spending.
It's about fiscal prudence. I mean, they're trying to prove they can write these huge checks for infrastructure while also signaling, that the house is in order.
Right, because this isn't just about next year. They've got a long-term goal for the debt to GDP ratio.
That's the anchor. They want to get it down to 50% by FY31. That's a very disciplined target.
And to get there, the immediate math has to work. So what's the headline number for this budget?
The fiscal deficit target for FY27 is set at 4.3% of GDP.
Which is a slight tightening, isn't it?
It is, down from 4.4% in the revised estimates. It's a clear signal to the markets that fiscal consolidation is real.
Okay, but you can't cut a deficit without the money in. The receipts side looks, well, a little ambitious.
Robust is the word I'd use. They're targeting total receipt growth of 7.7%.
And where is that coming from?
A lot of the heavy lifting is from direct taxes. They're projected to be up nearly 12%.
Which makes sense. Corporate earnings have been strong. The STT is bringing in more. That tracks.
It does. But there was one line item in that Kotak report that it really jumps off the page.
I think I know which one you're talking about. The other receipts.
Oh, yeah.
A projected jump of, what was it, 136%?
It's a massive spike, up to INR 800 billion. And that is not normal tax growth.
No, it's not. So what is that?
That's the big bet. It's banking almost entirely on aggressive disinvestment.
So selling off stakes in state-run companies.
Exactly. And that's a high-risk strategy. We've seen those targets get missed before.
Right. If the market isn't there, that INR 800 billion, well, it could just vanish. And then that 4.3% deficit target is suddenly in real trouble.
You're absolutely right. I mean, they're using the RBI surplus to cushion things, but that disinvestment target is the one big variable to watch.
It's like selling the family silver to pay for the new extension on the house.
That's a perfect way to put it.
Speaking of that extension, let's look at the money out. The quality of spending seems to be shifting pretty drastically.
It is. I think you could call it a pivot from handouts to build-outs.
I like that. So less on consumption, more on assets.
Exactly. Capital expenditure CapEx is really the hero of this budget. It's sitting at 3.1% of GDP.
And that's money for what specifically?
Massive allocations for roads, highways, and a really significant bump for the railways. Plus, defense spending keeps climbing. It's nearing 6 lakh crore now.
And to pay for all that, they have to be squeezing the other side of the ledger, the revenue expenditure.
Mercilessly. Subsidies are being slashed to just 1% of GDP.
Wow.
Yeah, especially fertilizer and petroleum subsidies. The message is clear.
Yeah.
We're not paying for consumption. We're paying for the assets that let you produce.
It's a big structural shift. So if all this money is flowing into infrastructure and make in India, who are the winners? Which sectors should you be watching?
Well, manufacturing is front and center, of course. There's a 40,000 crore rupee scheme for that.
Okay.
But there's some interesting niche plays, too. Like the 10,000 crores for something called biopharma, SHATI.
A push to move up the value chain from just generic drugs.
Exactly. But the one that really caught my eye was in technology.
Oh.
They've announced a specific tax holiday. Get this, all the way to 2047.
Wait, 2047? That's a generation.
It's a massive horizon. It's a nearly 25-year window for foreign companies that provide global cloud services from India-based data centers.
That's a huge geopolitical play. They want India to be the world's cloud hub.
That's the goal.
Yeah.
And they didn't forget the little guys. There's a 10,000 crore growth fund for MSMEs, and even an AI tool for agriculture called Bharat Vistar.
So the intent is there, the money is allocated, but as always, it all comes down to execution.
Always.
So for the listener trying to figure out their next move, what's the bottom line?
The strategy is clear. This is an investment-led growth story. So you want to be looking at the companies building the roads, the data centers, the manufacturing plants.
But with a big asterisk.
A huge one. You have to watch the rollout, you have to watch the execution.
And that brings us back to the risk. The government's math relies on two very tough things happening.
It does. One, successfully curbing subsidies, which is always politically tricky.
And two, hitting that massive disinvestment target, which is operationally very, very difficult.
So the final thought to leave you with is this. What happens if the execution of those asset sales lags behind?
If the political will wavers, or the market just isn't there, where does the money come from then?
Something to keep in mind.
A solid plan, but the execution is everything. Thanks for diving in with us.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.